Whenever traders are depicted in films, you think of characters shouting and screaming, making their trades and earning a huge amount of money, constantly on the go and barely sleeping. But do traders really earn the amount of money to warrant that kind of image? Or is there something else going on? With that thought in mind, I wanted to delve deeper into the salary of a trader, or if there is any insider dealings going on. In today's video, we will be taking a look at what is a trader's role, what is insider trading, some very well-known cases of insider trading, and the knock-on effects of being caught doing insider trading. Hello, and welcome to another KYC Lookup video where we bring you AML related content to help you enhance your knowledge in the fight against money laundering. Before diving into today's video, be sure to subscribe so you don't miss out on any future videos. Oh, and don't forget to leave us a comment with any suggested topics you would like us to cover in the future. We also have a special announcement to make, so be sure to watch until the end to find out what it is. So, on to today's video. What is a trader's role? Traders are responsible for making prices and executing trades in equities, bonds, commodities, and foreign exchange, usually dealing on behalf of or for the benefit of investment banks. A position trader buys and holds until the trend peaks. A buy and hold investor buys for the long term. Position traders may use technical analysis, fundamental analysis, and a combination of both to make their trading decisions. How much do traders earn? On average, a basic salary for a trader in the United States is $82,215. That's about £62,576 per year. With $30,160, that's about £22,955 commission per year. But this obviously varies from company to company. Not bad for a basic salary, we might say. But with most working hours reaching over 13 hours a day, on average 70 to 90 hours a week, and more workers pushing themselves to the limit, people are looking for other ways to put that extra cash in their pockets. What is insider trading? Insider trading is the buying or selling of a publicly traded company's stock by someone who has non-public material information about the stock. Material non-public information is any information that could be substantially impact an investor's decision to buy or sell the security that has not been made available to the public. This form of insider trading is illegal and comes with stern penalties, including both potential fines and jail time. A great example of insider trading is the film Wall Street, set in the high-flying city of New York in the 1980s. The film's main characters are Bud Fox, Charlie Sheen, and Gordon Gekko, Michael Douglas. Fox is an ambitious young stockbroker trying to make his way to the top. Seeing his hard work and doing whatever it takes to make it big, Gekko takes Fox under his wing and teaches him the ropes of insider trading. The film follows many twists and turns and ends with Fox questioning his loyalty to Gekko, and after falling out, they terminate their friendship with detrimental effects. Well-known insider trading cases. Samuel Waxel was the former Imclone CEO. Imclone Systems Incorporated was a biopharmaceutical company dedicated to developing biologic medicines in the area of oncology. It was founded in 1984 and had its corporated headquarters in Bridgewater, New Jersey, and its research headquarters in New York City. In 2003, Samuel Waxel was sentenced to 87 months in prison and fined $3 million after pleading guilty to 6 counts, including insider trading and fraud. Waxall sold Imclone stock after finding out regulators had rejected an application for the company's new cancer drug, Erbitux, a drug which was later approved. In connection to this, in 2004, style guru and media magnate Martha Stewart was convicted of obstruction of justice charges relating to her sale of Imclone stock. She was sentenced to 10 months split between prison and home confinement and fined $30,000. Her stockbroker, Peter Bakonovich, was also convicted. Another case is of Stephen A. Cohen, who ran one of the most admired hedge funds in the world, garnering some of the highest returns and highest fees in the industry, until its spectacular fall from grace in 2010, when federal agents raided the offices of two hedge funds founded by SAC Capital Advisors alumni, and later arrested several top traders at SAC, including Michael Steinberg and Matthew Mortimer. Cohen was not charged, but SAC Capital itself pleaded guilty to fraud charges and agreed to pay $1.8 billion to settle charges that it allowed insider trading for more than a decade. Steinberg and Mortimer are among those convicted. Another case that came to light was in 2020, when a former Amazon finance employee fed information to her husband about Amazon stocks. In 2021, he pled guilty to using insider information to place stocks on Amazon between 2016 to 2018, making them a profit of just over $1.4 million. The case was settled with the husband and wife team having to pay back over $2.6 million in penalties and interest. What is the knock-on effect from insider trading? One problem with insider trading is that it not only results in hefty fines and possible prison sentences for those who are complicit, but it can also have a negative knock-on effect on the stock of the company involved. Organisations such as the Securities and Exchange Commission, SEC, in the US, and the Financial Conduct Authority, FCA, in the UK, oversee the financial markets and attempt to maintain an even playing field. There was a time, however, that insider trading was considered legal and a victimless crime. But picture this. You sell a long-term holding to an insider just before an announcement that makes the share price rise dramatically. Now focus for a moment on how you would feel. You probably would not have sold if you knew the same information and you missed out on a big profit. Now it's more obvious that it's not really a victimless crime at all, and that in the end, someone, if not everyone, misses out. How are countries globally tackling this problem? Most countries around the world are making it a priority to target insider trading, and it is seen as a growing problem. In doing so, governments are tightening the procedures and laws to make it less easy for the crime to be conducted. In recent years, policymakers in the US and UK have tightened procedures governing the release of economic data. In the UK, for example, dozens of public officials used to get market-moving economic data 24 hours before the public release. After this practice stopped in 2017, we found evidence that significantly less informed trading ahead of the release, suggesting it effectively prevented a lot of insider trading. Well, there you have it. What is a trader's role? What is insider trading? Some very well-known cases of insider trading, and the knock-on effect of being caught doing insider trading. Please let us know in the comments section what other insider trading stories you know of, and what other procedures could be put in place to tackle the problem. Now for the special announcement mentioned at the start of the video. We have now launched our very own courses for you to take a more in-depth look at a variety of subjects, such as Introduction to AML, Beneficial Ownership, and customer risk rating, for example. So make sure you visit our website for further details. And let us help you connect the dots in KYC. Thank you for watching the video. And if you made it this far, don't forget to like and subscribe to watch more amazing videos.